Hey guys, in this video we'll explore the relationship between call options and stock prices using a simple analogy. Just like buying a house at a fixed price, call options give you the right to purchase a stock at a predetermined price called the strike price. As stock prices move, the value of call options can change too. I think this session will clear up a little bit of the complexity. Alright, so let's get in. Okay, here we go. So call option prices will increase as the stock price increases, and call option prices will decrease as the stock price decreases. So the price of the call option moves with the stock price. But why do call option prices move with the stock price? A call option gives the buyer the right and not the obligation to buy 100 shares of stock at the call option strike price between now and the expiration date of the option. Okay. Remember that one of the characteristics of all options is that they have a strike price, and in the case of all options, the price allows the option holder to buy 100 shares of stock at that price. That feature makes call options more valuable if the stock price rises well above the strike price, as the option can be used to buy shares at a discounted price. Therefore, the potential for gains from call options increases as the stock price increases beyond the strike price. I'm going to help you understand this concept more easily by using the purchase of a house. So let's imagine that I have a house and the current value of the house is $400,000. Now I'm personally interested in buying this house because I think that the value of the house is going to appreciate significantly over the next 2 years. But I don't want to buy this house the second, so I'm going to buy the option that gives me the right to buy the house at a price of $400,000 between now and 2 years from now. So we can call that strike price $400,000 since my option that I'm buying on the house gives me the right to buy the house for $400,000 or at the strike price of $400,000 between now and the expiration date in 2 years from now. I'm going to purchase an option that allows me to purchase this house for $400,000 no matter what the house price does in the next 2 years. It's not free though. I must pay the premium for this right. The owner of the house needs to be compensated for taking on a risk, which means that I must pay the premium for this option. For example, if I pay $10,000 for the option, I am guaranteed to purchase the house at $400,000 before the expiration date 2 years from now. If the house price rises to $550,000, let's say, in that time, I can still buy it for $400,000. This means if I pay for the option, I have no risk and only a reward. Okay, now let's say that 1 year from now, the house is valued at $550,000. But keep in mind that I have in my possession a financial contract that gives me the right to purchase the house for $400,000 within 2 years for a premium of $10,000. And now the house is currently valued at $550,000. What do you think that means for the value of the financial contract that I have, which is called an option? Well, as you might imagine, since I can buy the house for $400,000 when the house is currently valued at $550,000, the financial contract that I have, which is called an option, is immensely valuable. So now I can actually exercise my option, meaning that I will buy the house at the strike price, which is $400,000. And since the house is currently valued at $550,000, I am buying something that is worth $550,000 for a value of $400,000. And because of that, we could say that my profit in this scenario is $150,000. So that's the golden scenario. Now, because I paid $10,000 for the option, initially my net profit in this case would be a full $150,000. But it would actually be $140,000 since I would need to subtract the $10,000, which was the cost of the option contract. But let's say the opposite happened, and the house price did not increase in value but fell to $350,000 2 years from my purchase date of the option. Well, I don't actually have to buy the house for $400,000 because I had an option to buy it, but I don't have to exercise my right to buy the house at the strike price of $400,000. So I have the option of purchasing the house at a price of $400,000, but I'm not obligated to do so. Given that the house is priced at $350,000, I am unwilling to purchase it at the strike price of $400,000. This means that the option I bought for $10,000 is now worthless, as I could purchase the house at the market price. As such, I have lost the full $10,000 investment I made in the option. In comparison to buying the house outright, purchasing an option is far more advantageous. Had I bought the house without buying an option, I would have paid an initial $400,000, yet the current price is only $350,000, meaning that I would have lost $50,000. With the option, however, my losses are limited to $10,000. The limited risk and immense upside potential is why traders love buying options. So let's take all of these concepts that we just discussed with the basic house example, and let's look at it with a real example in the stock market.